Welcome to The Explainer. Today, we're going to build a clear, actionable playbook to help you find and analyze great companies. Look, this isn't about some get-rich-quick scheme. It's about learning to think like a real business owner, and we're going to break it all down step by step.
So, the big question, right? How do you find that next huge winner? Well, I'll tell you this. The answer is probably not hiding in these squiggly lines on a price chart. Nope. It's about really understanding the business itself. So let's dive in and learn how to ask the right questions, the ones that get to the heart of what makes a company truly valuable for the long haul.
All right, here's our game plan. First, we're going to look at the big picture, the industry. Then we'll zoom right in on the company's financial health and what makes it special. After that, we'll tackle a really crucial idea, the difference between a good company and a good stock. And we'll wrap it all up with two powerful models the pros use to spot those long-term winners.
Okay, first things first. Before you even think about a specific company, you have to look at the neighborhood it lives in. We're going to call it the racetrack it's competing on. I mean, think about it. A fantastic company in a dying industry is always going to be fighting an uphill battle.
And this quote, man, it just says it all, right? A company's potential is so often limited by the growth of its entire sector. It's just so much easier to succeed when the whole industry is booming and creating new opportunities for everyone.
So, where are the fast racetrack today? You got to think about sectors with these massive tailwinds, Things like AI, clean energy, and biotech. A rising tide really does lift all boats, and if you focus your search here, even smaller, promising companies can get a huge boost.
All right, so you found a promising racetrack. Now it's time to inspect the horse. And to do that, we're going to use this simple but honestly really effective analogy to check a company's financial health. We're calling it the mother-in-law test.
So this whole process breaks down into a simple 3+1 framework. We're going to look at three core financial checks. Is it profitable? Is it healthy? And how is its moat? Then we'll add that crucial +1, the price you actually pay for the stock. So let's start with the very first question your potential mother-in-law would ask.
Ha! She gets straight to the point, doesn't she? And so should we. This question is all about profitability. I mean, at the end of the day, is this business actually any good at making money?
And the best way to measure this is with the net profit margin. It's simple. For every single dollar in sales that comes in the door, how many cents does the company get to keep as pure profit? After paying for everything, materials, salaries, rent, taxes, the whole shebang. Now, what's really fascinating here is the difference. Your average company keeps maybe 8 cents on the dollar. But look at Apple. It keeps 25 cents. That incredible efficiency gives it this huge cushion to handle rising costs, fund new R&D, and just plain fight off competitors.
Okay, so the company makes good money. The mother-in-law, she's impressed, but she's not done yet. Her next question is all about stability. Is this company built on a solid foundation, or is it basically drowning in debt?
For this, we can use a really simple check called the current ratio. It basically asks, if this company had to pay all of its bills that are due in the next 12 months, could it do it with the cash and other assets it has on hand right now?
A ratio below 1, well, that's a major red flag. It means the company actually has more short-term bills than it has assets to pay them with. Ideally, you want to see a number over 1.5. That signals a healthy financial cushion, a business that isn't at risk of some sudden cash crunch.
So the company makes money, and it's financially stable. That's a great start. But now we get to what is, you could argue, the most important factor of all. What protects those profits? This is where we talk about the secret sauce that separates the good companies from the truly great, long-lasting ones.
We're talking about its economic moat. I mean, if a business is super profitable, you can bet that competitors are going to try to copy it. A strong moat is what keeps those invaders out and allows a company to defend its profits for years, sometimes even decades.
And moats come in all shapes and sizes. Apple has incredible brand power. People will literally pay more just for that logo. WeChat has network effects. Everyone's on it because, well, everyone's on it. And NVIDIA has this powerful technology moat built on its unique GPU designs. You want to look for a company with at least one of these really hard-to-copy advantages.
So, you've done it. You found a profitable, healthy company with a strong moat in a growing industry. You're ready to buy, right? Whoa, not so fast. Finding a great business is only half the battle. Now we have to figure out if it's a great investment.
And this is absolutely crucial. A great company is not always a great stock. Let me say that again. The best business in the world can be a terrible investment if you pay too much for it. Your return doesn't just depend on how the company does, it depends on the price you paid to get in.
Now, a quick way to check the price tag is the P/E ratio. It is not a perfect tool, but it gives you a rough sense of whether a stock is expensive or cheap. A high P/E means the market has really high expectations. A low P/E might signal a bargain, or it might signal a problem. It's just a starting point for asking, is this price fair?
Okay, let's head into our final section and tie all this together. To really level up our thinking, we're going to look at two powerful business models that have created some of the most valuable companies on the planet. This goes beyond just a single number. It's about the entire value creation engine.
This quote right here gets to the heart of it. Instead of just worried about last quarter's earnings, the best investors are obsessed with a company's ability to generate cash that they can then reinvest to grow even bigger. That's what creates that amazing compounding effect over many, many years.
First up, we have the Costco model. This is where a company gets more efficient, and instead of just pocketing all the extra profits, it passes those savings on to you, the customer, with lower prices or better service. This builds this incredible amount of trust and loyalty, which becomes its own kind of moat, and it creates a growth flywheel that competitors just can't stop.
And second, you have the NVIDIA model. This is a totally different playbook. This is about a company that spends a decade, maybe more, just quietly investing in deep, really difficult technology. The market might ignore it for years, but then a massive technological shift happens, like the AI revolution, and bam, that decade of investment pays off exponentially, catching absolutely everyone by surprise.
And there you have it, a complete playbook. From finding the right industry to understanding a company's finances, its competitive edge, and its long-term value engine. So the real question now is for you. As you look at the products you use and the services you love every single day, which of those businesses pass these tests?